So anyhow, it's so that's the method I described, adjusting the median pre-money valuation for the startup deals in a particular region, and then you can see factor into the 7 characteristics of the company. So let's not go into details. And the last one is value, I think, basically see the risk factors throughout the startup. How many risks you have, and you can actually undermine the value of the startup. So if you can look at these risks on the second list, there are actually lengthy list about IP-related risks, litigation. A lot has to do with infringement. Actually, if you look at all the startups having litigation risks, infringement on copyright, infringement on trademarks, sometimes patents. And then you have technology risk, meaning that if your technology is not protectable by any of those IP forms, it may be actually easily copied or infringed, and then you don't have a competitive edge. So these are the last method. So good. Now we have laid down the background. We can actually get into the serious discussion about IP asset valuation. I just listed 3 examples throughout the history, and I think most of these deals happened in 2012 to 2013. I did not list the largest deal happened in 2012, which was a deal between Nortel and a consortium of companies, amounted, I believe, to more than $1 billion for its IP portfolio only. So only intangibles, only its patent portfolio. That's Nortel. I think a lot of people may not even, because you're so young, so they may not even remember or heard about this company. Who is Nortel? Nortel is one of the largest telecom in 1970s, 80s, I think, 90s as well. And then it defunct because all the manufacturer of telecom equipment got bombarded by wireless communication, internet, voice over IP. Technology innovations have left all the giants behind. And the only one get out very well is AT&T, because it transformed itself to a very well organized carrier, network provider. As Laurent pointed out, that one time I was so proud to be working for Bell Labs at Lucent, AT&T. It is actually non-existing now. It's part of Nokia. It was sold to Alcatel. It's a merger, and then recently Alcatel has to be bought by Nokia because there's no market share who can absorb all these equipment manufacturers. So anyhow, that's Nortel's patent portfolio was sold more than $1 billion to a consortium formed by Microsoft, Apple, Sony, Samsung, and one of our Asia's pride, ZTE, was interested at one point. We worked with them to be participating in this bidding process, but I think this kind of risky game was not very much ready for Asian companies at the point. I'm sorry, Chinese companies, because Samsung is Asian, Sony is, I'm sorry, to accurately speaking. So anyway, these are the deals that relates to more Apple or Microsoft or Interdigital, which is a company develop only wireless technologies and filing patents and don't really make any products. So why do they have this kind of crazy value? So how do they value the IP assets? Well, I have to correct that today because of my background, I used examples and also the methodologies are mostly focused on valuation of patents as an IP assets. Trademarks valuations are different because trademarks lifetime and patents lifetime are different, and also the way of valuing them are quite different. So I would not expand today's discussion to also trademarks. The general principles or concepts could be related, but they are not exactly the same. So for IP or patent portfolios, we use several methods as well. Also could be identified as, these methods are not exactly accurate. We may as well just take a market approach, because I know lots of investors or companies who does aggregation of patents actually use market approach. Basically, how much I can sell it. But how much you can sell it, what is the basics? What is the basis of the value? You still need a formula. You need some kind of a structure to basically give you an idea. So the classic method, we use cost and income approach and market approach. I will go into detail for cost approach and market approach. For income approach, is basically you see how much you can generate from this pool of patents. If you have technologies associated, you can ask for more money, but generally you give them the rights to use these patented technologies, and you ask for a royalty. And that royalty is your future value, is your future income. And then obviously this incremental revenue method means if licensee, which is the one who is getting these licensing rights, their revenue is increasing, then how do you calculate the royalties? So I think we're not discussing a lot of accounting methodologies today, so we don't have to go into details. But in general, the income approach is focusing on how much income this pool of IP assets can generate. And then you have this other type of approach, which are the quantitative methods. This is even more accounting focused. I wonder if any accountants on site could opine on these two methodologies. No? I think maybe it's not really important to go into, because if the startup or any of our companies have a pool of IP portfolio, we want to use this method, you have to hire an accountant anyway. The factors to consider. So when you do valuation of an IP portfolio, especially patent portfolio, the important factors you can lay, basically if you want to sell your portfolio to a potential buyer, what factors do you put in to justify the 20 million you ask for? First, you calculate the development cost, which are the salaries of these researchers, and also the machineries, if you need any of those. Obviously, in overall, that's called R&D cost. So your R&D investment over the 5 years term, you develop these portfolios. That's your investment, development cost. Also, part of the development cost is the filing cost and maintenance of these patents. Those are quite significant. Why? Because if you have a pool of 100 patents, each one of them cost $30,000 to $50,000 to file, very complicated, and to maintain. And it's each year, and patents are maintained on an incremental, there are different stage you have to pay a maintenance fee. So your cost to maintain a very significant patent portfolio is quite high. And then you have the potential market value. Obviously, that's when we say, I have 5 patents. It's all about voice recognition. My voice recognition technology really surpasses everyone else. That's Motorola, right? They're not only having 5, they have 50, they have more than 100. Their voice recognition technology is really, really good, and they have all been protected with patents. And they can now, I'm giving an example, they can now sell these technologies or license these technologies to many wireless manufacturers, because the rest of them have no voice recognition technology, or they do have one, but they always tell the wrong signal, wrong words, wrong. So that's your potential market value, how much you can license them each year. You calculate the licensing royalties based on each manufacturer's market cap. So who is the largest? Samsung. In a particular marketplace, it sells, I don't know, on top of my head, 40 million gadgets in Korea, and Motorola's patent portfolio are well covered worldwide. They can sell, they can give a license based on each gadget you sold, and you pay a royalty on that particular price of that gadget. So to put it very visual is, if you sell for $10 each phone, and by adding this voice recognition technology, you can sell to $15. Then that $5, you give a percentage to the original patent owner. The percentage could range from anywhere 3 to 5, even higher percentage. So that's your potential market value. And I also covered potential royalty calculation. Litigation cost and validity assessment, that's very important, because if you have a litigation risk and you get involved into litigation, obviously in this part of the world, maybe it's not the end of the world, and it's not the most deadly thing to make you bankrupt or anyhow. But in certain marketplaces, such as United States, Europe, some parts of Europe, and also Northern Europe, and if you get into litigation, your market is going to be hurt drastically. You might have to consider that. And also the litigation risk to defend yourself, average is about 1 to 3 million US per year in the US District Court. Yes, please.
Are patents still relevant for a startup?
Of course. Well, you ask the choir to talk about classical music. Yes, I believe yes, but I also understand your point of view is that some startups don't really have a patentable technology.
Or the capital.
Oh, the capital. Actually, I represent quite a few startups. I know capital concerns is always the biggest concern when it comes to protecting their IP rights. But nevertheless, if you have, let's say, some startups would think it's more important to hire people, and some would say it's more important to actually make a product and make a prototype, and so we can actually get market traction rather than protecting IP, meaning like go through the process filing trademark protection, filing a trade dress protection, more so filing a protection for the technologies if it's patentable. But I think these are different philosophies. Obviously, you run into the risk if you have a product and you have a patentable technology, but you don't have a protection. If you make a product, you put the product on the marketplace, and you sell. Obviously, you can, like Xiaomi, their phone, right? You can have millions of sales each month. But if you have one protectable proprietary technology embedded in your phone, and that could be, your value of that piece could be way beyond the sales. Because the sales, the margins are lower. I'm sorry to point out an example that has very low margin. There are also startups who have a product that's maybe not so heavily embedded with a lot of patent technologies, but yet very high margin. I can't think of any. Maybe, let's say,
Gucci bag.
which one? Sorry?
You said a Gucci handbag.
Oh, Gucci handbag. Yes, that's copyright, design rights, and look and feel. Well, Gucci bags is protected everywhere, in any way, any form, any shape. No, I was thinking about this product. GPS, when it first came out, I'm not sure it was very broadly protected. But the first company made GPS. Obviously, they became very, now is Fortune 1,000 companies that they have huge patent portfolios. But there are companies who make products in the beginning and they were not. But honestly, if you have any funding, first round of funding, angel funding, very small amount of funding, educated companies always put in to protect their IP rights. Because, think about it. If one day you don't want to work on this product or you don't want to work on this company anymore, you have many ways to exit once you have a protectable rights. If you don't have any protectable rights, the only way, like traditional businesses, we run a grocery store in the past, and you have nothing to protect. The only way to sell your business is to sell, I guess, your inventory, your lease. That's it. You have no way to maximizing the value or grow the value. But if you have rights such as transferable rights, maybe they are intangible, but it could be applied, multiplied, and it would be applicable to many businesses and to worldwide, then you have much better way to exit. So first thing to think is, can I create something really, really protectable by IP, any kind of IP form? If I'm not able to file a patent protection, I can have a copyright protection of my algorithms. And it's not really that expensive to file a copyright. You just deposit the copyright and you get copyright protection.